And welcome. This is Mary Ellen McGonagle with the MEM Edge Show, brought to you each and every Friday afternoon at 5 p.m. Eastern Time. And this is where we, of course, put you in front of where the action is in the broader markets. And we certainly had a rather explosive end to the markets this week. So as usual, we're going to have a fair amount to cover. My goal here is to really help you put your arms around where the markets are now. We're going to use history as precedent and guidance. But let's go ahead and get started. Take a look at our agenda for today. As usual, we are going to, as I mentioned, take a real good look at the broader markets, get a sense of where we are relative to the sell-off this week. And we are going to look at strength in a weakened market. There are pockets of strength, and surprisingly, not all of those pockets are defensive. There are some high growth areas that are really hanging in remarkably well. So we're going to take a look at those two areas, or actually several areas that are showing strength in this market, despite the broader markets being down quite a bit this week. The potential impact of coronavirus, here is where we are going to drill down to those expected areas that are going to be the most negatively impacted, and that where we are right now as it relates to a potential slowdown in China. A lot of the fears that were previous were rather imagined, but now we do have some very real reasons to be concerned about China's growth being at least the pause button being hit. So we're going to look at some areas that are right in the firing line of a potential slowdown in China and that will be impacted the most. And then seeking safe haven yield stocks, I set up a very nice screen in StockCharts.com that I can share with you. And I'm also going to share with you some stocks that do offer dividends that are holding up really well and look relatively attractive. And then we are going to cover just a few stocks that are due to report earnings this week. We had this past week was the heaviest week as far as reported earnings for Q4. And this is where some of those pockets of strength are coming in among growth. Those companies that came in with really excellent earnings are being supported and they are being bought. So lots to cover today. Let's go ahead and jump right in. I'm going to begin as usual, taking a look at the S&P 500. This is a fairly marked up chart. It is a daily chart of the S&P 500 and a couple of things that I do want to share with you. But what we're going to do first is drill down to the current markets. And then I've marked up some prior pullbacks that occurred this year as historical precedent, just to give us an eye toward what may occur. Then we're going to drill out and look at a bigger, longer term picture and take a look at some more serious corrections, and that's going to be at least 10% pullback. But again, really just to get a good sense of where we are currently and what to be on the lookout for. So as usual, on this daily chart, we want to pay attention to the position of the S&P 500 relative to my first line of defense is this shorter term 10-day simple moving average. So when we're in a confirmed uptrend, this uptrend began back here in October, this nice gap up above these simple moving averages. And for the most part, we've been in a nice uptrend since then. So as long as we are finding support at this upward trending 10-day, I'm going to be quite constructive on the markets. Once this index, the S&P, and of course it could be for the NASDAQ, the Dow as well, once we do break that 10-day simple moving average, it's not a red flag. It's very simply a yellow flag. I want to look at these other outlying technical signals to get more of a sense on where we may or may not be currently. So up at the top there, I do have that RSI indicator. We again, during this nice bullish uptrend, the RSI was also trending upward and it was also above this 50, which is generally viewed as your neutral. So here we have a couple of periods where this RSI did get overbought above that 70, and we quite constructively had nominal pullbacks as the uptrend continued. But take a look at where we are currently. That RSI, and this is based on today's trading activity, it did decisively break it back down below that 50. Now, of course, we did have that sell-off on Monday, and for the remainder of the week, the markets were showing tremendous resilience. The RSI did get back up above 50, but today's news was too much to bear. So now we have this RSI on the daily chart that is trending downward and below the 50. Let's go ahead and drill down, take a look down here at the moving average convergence, divergence, and that is another momentum indicator. We're looking at this black line relative to the red signal line. We can see the black line did cross down below that red, indicating a potential shift of that upward momentum. Now, this occurred earlier in the week, and it is still trending downward. I'm going to see if I can I'm going to pull up the stochastics. This is full stochastics are another momentum indicator that can be quite helpful, both in the shorter and longer term. So here we have the stochastics, and I really want to bring this up because we want to pay attention, again, to the position relative to this net neutral 50, and then the slope. So we can see the stochastics, another momentum indicator, is also trending down below that 50. So let's take a look at what this is all telling us, because what I want to do is go back and review these 3 pullback periods that occurred earlier this year. Now, the reason I am pointing toward this is twofold. One is the fact that these pullbacks, by and large, they were trade war related, but also global growth related, and certainly had everything to do with China. So there is relevance to this pullback. From my work at this point in time, I am anticipating a less, certainly there are those out there that are calling for 10+% or more. And certainly no one has that crystal ball, but at this point in time, I'm using these more nominal pullbacks for historical precedents as to what to be on the lookout for should we see continued deterioration. And the first thing that going back here during each of these pullback periods was a price break below this red 50-day simple moving average. And from my work, this is true for stocks as well as broader market indices. Once they break this 50-day red simple moving average, from my work, then that yellow cautionary flag does become a red flag. I'm not going to go entirely to cash, but I am going to closely examine each of my positions, understand my stance for that given stock. But for the most part, a break below that 50 on volume would have me heading for the exits potentially. But let's take a look at where we are currently, because each of these previous periods, we did get further, just a bit more deterioration, but more importantly, going back to this August period, we had a lengthy general period of underperformance, while May was, of the 3, the most severe. We did not only break this 50, we also broke below that 200-day simple moving average. So during this period of deterioration, I'm also pointing out that higher volume on those days when the markets are down, that's indicated in red, that's telling you that the markets are under distribution, and it is a negative. So let's go ahead back to where we are currently. We have that negative RSI, we have that negative stochastics, but the 50-day, the broader market indice is finding support at that 50-day simple moving average. So what we can do over here is show where that 50-day is currently. It's at 3211 on the SPX, and the that's the position of the 50-day simple moving average, and the S&P 500 closed at 3225. So we are above that 50-day. So that's good, but it doesn't mean that you can fall asleep at the wheel, so to speak. So what I do from here is then, and I would obviously recommend you doing this, but this is for clients of my MEM Investment Research, my MEM Edge Report. We drill down much more as far as into the markets and then into individual stocks. So we're going to take a really close look at each holding of the MEM Edge Report on our suggested holdings list and examine the dynamics of each single stock so that if there are serious breaks and violations below that 50-day, oftentimes it is a signal to exit. So that's where we are currently. I'm probably not being clear. Where we are currently is mixed in the sense that we are getting negative RSI, negative stochastics, but we are finding support at this 50-day. Now, this is going to be of these the most, have the most import for my work. These RSI and stochastic indicators are very, very near term. We can go back historically and see that they have been able, certainly during this shorter pullback here at the end of September, able to recover. But each day, of course, is going to bring its own set of clues. Let's take this a bit further. I wanted to broaden this out. Take a look at the weekly view of the S&P 500 and using those same pullback periods as guidance, this weekly is going to, of course, keep you in. It's not quite as whippy. I'm going to go ahead and pull up the stochastics here on this weekly so we can get a little more in the way of a bigger picture, longer term updated view of the markets. So on these stochastics, what we want to pay attention to is the fact that during these pullback periods, the stochastics never really get below 50. It's not until we get into back here bear market territory when it drops. So when it drops the stochastics below 50 on your weekly, and when your RSI gets below 50 on your weekly, that is going to be really quite concerning because it is going to point to certainly more than a 5 to 7% potential pullback. So that's a bigger picture view. Let's go ahead and drill down, take a look at some of the sectors because, of course, we want to know where the strength is within the markets, if there is any strength being exhibited, and which areas are currently being hit the hardest. So we're looking at here is a candle glance view of those 11 sectors within the S&P 500. And then we also have the actual S&P 500 sprinkled in here. And what I've done is gone ahead and added an RSI, that relative strength indicator, sorting it by descending. Go ahead and update that. We want to see, again, strength up here in the upper left side, weakness down on the lower right. So up here in the upper left, take a look at utilities. This is an area for the last 3 weeks we have been pointing out has been exhibiting superior outperformance. And of course, utility stocks by and large are defensive. There are other underlying dynamics at play, but they also are domestic. These companies provide energy to companies within, for the most part, within the US. So that is also one other reason that they are somewhat being protected. So utilities up here in the forefront. Take a look. Now, tech stocks did get hit. This is a daily, 2-month daily view of these various sectors. We can see tech got hit 3% today. We're going to drill down as to precisely why, and we did touch on this in last week's MEM Edge show as anticipating one area within tech that is continuing to get hit. But by and large, it is staying up here in the forefront. We're going to look at a couple of heavyweight stocks within tech that are holding up well as one area that is really showing remarkable relative outperformance. But technology is still up here in the forefront because of those other factors, despite that one area that's continuing that's very China focused. Real estate stocks, these are REITs. These is another defensive area with higher yielding stocks underlying. The REITs sector actually was down 2% for the week. Now that's in line with the S&P 500, not what you would expect from REIT stocks. But we are going to drill down, and I'll share you in one snapshot why this group is showing negative, but don't overlook it. There are clear-cut pockets of strength, and we're going to look at that as well. A mixed bag here with the consumer staple area. A lot of heavyweights there are actually holding up. We're going to cover that when I share with you some of those high yielding stocks that are doing fairly well. And then we can see discretionaries. Now, of course, discretionary shows this big pop today. And this is where knowing what stocks are underlying and the holdings among a sector as far as the heavyweights is really going to be quite helpful. Amazon came out with numbers today. It popped as much as 8%, and Amazon is far and away the largest component of discretionary. So I will argue that this view that you are looking at is distorted. Discretionary stocks are getting hit. A lot of hotel, travel, those areas are really getting walloped. So this is a little bit masquerading, if you will. But go ahead and let's move down because we want to get to some of these other areas. Healthcare getting really hit, and a lot of this has to do with biotechnology stocks. This is a very risky area of the markets. Biotech stocks were down this week almost 3%. Big hit as risk off. Investors want to be in safer haven areas. And then we can see energy getting hit the hardest, very close to bear market territory for energy stocks. So I'm going to leave it at that for 1 minute. We have a very quick break and lots more that I want to share with you. So stay tuned and we will be right back. Welcome back. So we have one other area that I do want to cover with you as far as drilling down beyond those market indices into select areas of the market. And then we can get to the fun stuff and look at areas and stocks that are holding up. So this is another view of the markets. We're using not so much the sectors here, but what we are looking at is the NASDAQ, the S&P, the Dow, and then also some of those underlying growth areas that I really follow quite closely, and that's going to be semiconductors. We're going to also look at software stocks. We want to see where gold is, volatility. I talked to you about biotechs as well, but we also want to look at the yields and small caps. So let's take a look. RSI descending, strength to weakness. So up here in the upper left portion, take a look. Not a big surprise, but we are seeing gold stocks holding up well. This, of course, is a proxy for a safe haven area. We can drill down and I'll share with you a couple of better names in there. Volatility did spike this week and it closed above that from my work above 18 is when we can anticipate more potential downside in the broader markets. And the VIX did close at 18.8. Let's go ahead and blow this up because we want to look at historical precedent. We currently are at that 18 level, which is yellowish red flag from my work. And then I shared with you earlier those corrections. The May period, we did get the VIX got as high as 24, taking us to that August. All of this, again, had to do with trade war fear, global growth fears. In this instance, we almost got up to 25, but 18 from my work again. This is that September period that was the most, as far as benign, as far as the pullback, but we did get up here to this 21 level. So you want to use history as your precedent in the sense that when we do get above this 18, by and large, that is a period where volatility certainly has increased and we can anticipate near term more downside for the markets. But this is one area within technology. I'm looking at IGV. It is a software ETF and it is holding in remarkably well. This is that one area among tech that I mentioned to you. A number of these companies are coming out with very solid earnings. And I will argue because they are software enterprise, in other words, they have contracts with huge corporations that are paying them either monthly or quarterly or annually, this is viewed as regular potential income stream. So there are those that view software as defensive because of that continued income potential. So as we drill down even further, this area, the semiconductors, is that one area that is getting really hit hard. We talked about it last week. Most of the companies in semiconductors do derive a good portion of their income from China. So a slowdown in the Chinese economy is going to impact semiconductors. There's just no way around it. Down 3.6% today. Take a look, broke below this 50-day simple moving average on volume. And we can see that semiconductors, going back to those other three pullback periods, have gotten hit again because of their China-focused nature. Let's go back. We want to also make sure that we don't miss, we would be remiss. When we see 10-year yields, this is the chart, 2-month chart of the yield of the 10-year dropping this precipitously. This is telling us that buyers are going to the safe haven U.S. Treasury bonds. And we talked about it last week, but I'll share it again with you this week. The treasuries and when yields drop is double-edged, both good and bad. Of course, as these drop, bank stocks are going to falter because they strive and thrive during higher interest rate environments and when the shorter and longer term spreads are there. But there are bright spots for when these interest rates yields drop, and that's going to be REIT stocks and housing, although housing didn't hold up quite as well this week. But again, two particular different ways that you can look at that. I did want to share with you the fact that the Russell, let's go ahead and pull this up here so you can get a broader view. Rather disappointing because we did have this period going into the first half of January where the Russell 2000 small cap stocks charging to new highs. Very exciting. This is all about at this period of time, an upgraded outlook on U.S. economic growth. Now, of course, since then it's stumbled. This was the first index to break below this 50-day simple moving average, and we can see huge volume on today's 2% decline. And looking at this MACD, not only did we have this negative crossover, but we're poised to turn negative. So that is quite disappointing. So that's the markets, certainly as to where the broader markets stand and the various sub-industry groupings. What I want to go ahead and share with you now are just a couple of different other views that can be helpful. This is that look at the financials versus the treasuries, and we can see treasury yields dropping rather significantly. But let's take a look because I want to share with you those pockets of strength that I mentioned to you. So I'll share with you how you can get to that rather quickly using StockCharts.com. What we're going to do is go right to the sector summary, and I want to look at the 1 week view. This is an exercise for those of you each and every week, gives you a sense of where strength or weakness is. And we're looking at quite simply the performance over this past week. So while you'll see some areas that are negative, I would urge you to just take a minute and go ahead in and look at the underlying areas. What I'm going to do is start here with financials. I mentioned to you that bank stocks are going to be very susceptible to that drop in the U.S. Treasury yield. But let's take a look up here. Insurance brokers, property and insurance, these guys are holding up well. And I'll tell you, our earnings season is going on. It could be earnings related. So 2 things I'm going to do right now. The first is let's take a quick look at their charts, because this is a phenomenon that I do recall during those prior market pullbacks. These stocks did, for the most part, hold in well. So this is the Dow Jones U.S. Insurance Brokers. We can see hitting a new high. This is that May correction. Take a look at this relative outperformance while the broader markets sold off. We can also do the same with property and insurance. take a look. This is that May corrective period. We also had that correction in August, and we can see that these stocks fare well when the broader markets are dropping. So what I'm going to do is hopefully see if I can pull up this proper, yep, here we are. So I pulled up what's called a perf chart, and you can get this on StockCharts.com. I have the NASDAQ, the S&P, but I also populated this chart with that Dow Jones U.S. Property Casualty, Dow Jones U.S. Insurance, and utility stocks. Let's take a look during those periods when the broader markets fell into a correction, actually a pullback. So this is that April into May. These lower lines here are the NASDAQ and the S&P. Take a look at the clear deterioration. However, up top here, we have the insurance as well as utility. And you can see that these areas do outperform during periods of underperformance. So from there, what I want to do is go ahead and share with you. Let's see if we can get back to this utility area, but I can certainly share with you some stocks within those industry groups that really are looking quite remarkable. So first one we can take a quick look at here is Progressive. I'm going to blow this up a little. We're looking at a daily price chart of Progressive Insurance, PGR. And again, relative outperformance while the broader markets faltered. This gap up here has everything to do with earnings. They came out with their numbers earlier this week, gapped up, big volume, retaining that improvement, forming the right side of this base. So for those of you that are looking to counterbalance some of your maybe more growthier names, you can consider a stock such as this. GSHD is another, and we are running out of time, but this is another company, insurance, that did report numbers. And then I'm going to leave it at that because I would be remiss without sharing with you some of the stocks that are in the firing line and are maybe dampened because of the coronavirus. And this is Starbucks. The stock did report earnings. They guided lower all because of the coronavirus. They closed thousands of stores in China. Take a look at this big volume pickup as the stock breaks down. Another China-focused retailer is Nike. Their past earnings calls, they cited China as the reason for their big outstanding growth, particularly digital, breaks the 50-day, big volume. We, of course, talked about semiconductors stocks being very much in the firing line. We can also look at some of these gaming stocks. This is LVS, big presence in Macau. Stock is breaking down now. It is trying to recover. Whether the Vegas area is going to be able to help them withstand. Now let's move on and take a look at some positive areas among consumer staples. KO is Coca-Cola. The company reported numbers, gapped up, everything to do with their Coke Zero, low sugar sodas. Stock is charging to new highs, 2.7% yield. PETS, 4.2% yield. A little bit of a funkier looking chart, but they came out with good numbers. They had very good holiday sales numbers. That's another potentially positive one. And then I mentioned to you about REIT stocks, and I just want to take 1 minute here to go into that because the REIT stocks that are getting hit the hardest are those that are focused on the travel. So quite simply, I'm going to share with you a weekly view again. We are going to go into this real estate sector fund and take a look. It's retail and lodging that are getting really walloped, rightfully so, with the coronavirus fears. But up here, mortgage and diversified REITs are holding up remarkably well. So there are definite bright spots among these REITs that you can go ahead and utilize as potentially defensive areas. I'm going to go ahead and leave it at that. For those of you trading, happy trading. Have a great weekend.